For years, factor investing, a strategy targeting specific investment characteristics like value, momentum, or low volatility, reigned supreme. Chasing the performance of factors like quality and size offered investors an alternative to the broad market, often with the promise of enhanced returns and reduced risk. But 2023 painted a different picture. Factor ETFs, instruments designed to track these specific market segments, faced an unexciting and poor year, lagging behind broader benchmarks and raising questions about their future. 2023, a year of factor underperformance. The past year witnessed a near-universal underperformance of factor ETFs across various categories. Value factors, value stocks, historically known for their lower valuations relative to their earnings or assets, struggled against their growth counterparts. The iShares Russell 1000 Value ETF, IWD, returned a meager 7.3% compared to the iShares Russell 1000 Growth ETF, IWF, as 21.2%. Momentum factors, stocks exhibiting strong past performance, a key tenet of momentum strategies, failed to sustain their upward trajectory. The Vanguard Momentum Factor ETF, MOM, delivered a mere 5.4%, lagging behind the Vanguard Total Stock Market ETF, VTI, as 17.4%. Low volatility factors, while traditionally offering a smoother ride, low volatility strategies also met their match. The SPDR S&P 500 Low Volatility UCITS ETF, LOVW, experienced a negative return of -1.3%, while the broader S&P 500 soared by 25.7%. This widespread underperformance led some to label factor investing as broken or a fading fad. However, attributing the phenomenon solely to a faulty investment thesis would be hasty. Several factors contributed to this unexpected downturn. Macroeconomic shifts. The 2023 market rally was largely driven by a combination of easing inflation concerns and improving economic data. This environment favored growth-oriented companies with higher expected future earnings, leaving value and other factor portfolios behind. Central bank policy. Rising interest rates in 2023 disproportionately impacted certain sectors and investment styles. Value stocks, often concentrated in interest rate-sensitive industries like financials and utilities, faced headwinds from higher borrowing costs. Sector rotation. Shifts in investor sentiment led to rotations out of sectors traditionally associated with specific factors. For example, the retreat from defensive utilities and consumer staples, known for their low volatility, weighed heavily on low volatility ETFs. 2024, a glimmer of hope or continued gloom? Despite the 2023 challenges, it's crucial to remember that factor investing holds a long and successful track record. While short-term underperformance can occur, factors like value and momentum have historically delivered superior risk-adjusted returns over the long term. So, should investors abandon factor ETFs altogether? The answer, as with most investment decisions, is nuanced. Here are some key considerations for 2024. Market environment. Predicting the future is always a fool's errand, but understanding the prevailing economic and market conditions is crucial. If the 2023 trends of strong growth and rising interest rates persist, factor underperformance might continue. However, a shift towards a more moderate or recessionary environment could create fertile ground for value and other factors to shine. Active versus passive. While many investors access factors through ETFs, actively managed factor funds can offer additional flexibility and adapt to changing market dynamics. Cost versus complexity. Factor investing, whether through ETFs or active funds, adds an additional layer of complexity compared to broad market strategies. Investors must weigh the potential benefits against the added fees and complexity before diving in. Ultimately, the decision of whether to embrace factor ETFs in 2024 rests on individual risk tolerance, investment goals, and long-term outlook. While the recent underperformance may raise concerns, dismissing factor investing entirely would be overlooking its historical merits and long-term potential. A cautious approach, informed by market assessments and careful consideration of individual circumstances, is vital for navigating the ever-evolving landscape of factor investing in 2024 and beyond. Beyond the headlines, diving deeper into specific factors. As we saw in the broader perspective, 2023 may have been a challenging year for certain factors, but beneath the surface lies a more intricate story. Let's delve deeper into the performance of specific factor categories and explore potential strategies for 2024. 1. Value, a return to favor? Value stocks, despite their historical outperformance, struggled mightily in 2023. However, several reasons suggest a potential comeback could be brewing. Valuation gap. The persistent outperformance of growth stocks has widened the valuation gap between the two styles. Value's inherent discount relative to its fundamentals could become increasingly attractive as market sentiment normalizes. Macroeconomic shifts. Concerns about inflation and the economic slowdown could shift investor focus towards companies with reliable earnings and cash flow, a hallmark of value strategies. Technical indicators. Some technical indicators like the death cross, where the 50-day moving average crosses below the 200-day, have historically coincided with value reversals. While not foolproof, such signals suggest potential inflection points for the style. Strategies for 2024. Sector rotation. Consider value-heavy sectors like financials, utilities, and consumer staples that faced headwinds in 2023. Active management. Employ actively managed value funds that can navigate specific undervalued pockets within the broader market. Income focus. Prioritize value stocks with strong dividend yields, offering both capital appreciation and income generation potential. 2. Momentum. Finding new engines. Momentum strategies, reliant on past winners, encountered unexpected hurdles in 2023. However, adaptation and diversification are key to finding new momentum engines. Sector-specific momentum. Instead of a broad market approach, look for pockets of momentum within resilient sectors like healthcare or technology. Thematic overlays. Consider momentum ETFs aligned with thematic trends like clean energy or cybersecurity, where strong growth narratives exist. Short-term momentum. Explore tactical momentum strategies focusing on shorter time horizons to capture quick, market-driven shifts. Strategies for 2024. Focus on quality momentum. Seek companies with strong financial health and consistent earnings growth within momentum-driven sectors. Active management advantage. Utilize actively managed momentum funds that can dynamically adjust to changing market conditions. Global momentum diversification. Look beyond domestic markets for momentum plays in emerging economies or specific geographic regions. 3. Low volatility. Seeking smoother waters. While low volatility ETFs underperformed in 2023, their ability to navigate turbulent markets remains valuable. Refining your approach can unlock their true potential. Quality low volatility. Combine low volatility with quality factors, seeking stable companies with strong financials and consistent earnings. Factor rotation strategies. Implement dynamic factor allocation, switching from low volatility to other factors like value or momentum during periods of market stress. Tactical options. Consider using low volatility ETFs as hedging instruments during periods of high market uncertainty. Strategies for 2024. Sector-specific low volatility. Target low volatility stocks within defensive sectors like consumer staples or utilities that offer downside protection. Active management expertise. Leverage actively managed low volatility funds that can navigate specific low-risk opportunities within the market. Multi-asset integration. Combine low volatility ETFs with other asset classes like bonds or gold to create a well-diversified portfolio resilient to market shocks. Remember, factor investing is not a set-it-and-forget-it strategy. It requires ongoing analysis, strategic adaptation, and a keen understanding of the underlying risk-return dynamics. By venturing beyond the headlines and diving deeper into specific factors, you can unlock their potential and navigate the ever-evolving investment landscape with greater confidence in 2024 and beyond.